If you're looking to build a steady income stream and grow your wealth over time, dividend investing might be the strategy you need. Today, we're summarizing the book Dividend Investing for Beginners by G.R. Tiberius. This book is a comprehensive guide for anyone new to dividend investing, explaining the basics and diving into strategies that can help you make informed decisions. We'll go through each chapter in detail and show you how to apply these insights to your own financial journey. And if you want to dive deeper into this topic, you can find a link to the full book in the description below. Let's get started. This is Wealthlocity. Here you create, protect, and grow your wealth fast. Chapter 1 lays the foundation by explaining what dividend investing is all about. Dividends are regular payments made by companies to their shareholders, usually from their profits. Tiberius starts by clarifying that dividend investing focuses on buying shares in companies that consistently pay dividends. This approach provides a dual benefit. It offers a regular income stream and the potential for capital appreciation as the stock price grows over time. He also explains the difference between dividends and other forms of investment income, such as interest from bonds or capital gains from selling stocks. Dividends are unique in that they reward shareholders for holding on to their shares, aligning the interests of the company and the investor. To get started with dividend investing, research companies with a strong track record of paying dividends. Look for well-established companies, often referred to as blue-chip stocks, that have consistently paid and increased their dividends over time. Tools like dividend screens or financial websites can help you identify these companies. This strategy will help you build a portfolio that generates reliable income while potentially growing in value. In Chapter 2, Tiberius delves into the benefits of dividend investing. He explains that dividend stocks not only provide regular income, but also tend to be less volatile than non-dividend paying stocks. This stability makes dividend stocks a safer option during market downturns. He highlights the power of compounding as a critical advantage of dividend investing. Reinvesting dividends to buy more shares can significantly accelerate your portfolio's growth over time. Tiberius also discusses how dividend-paying companies are often financially strong and have a long-term focus, which can make them more resilient during economic challenges. These companies typically have established business models, steady cash flows, and a commitment to returning value to shareholders. One practical way to maximize the benefits of dividend investing is by enrolling in a dividend reinvestment plan, or DRIP. A DRIP automatically reinvests your dividends back into the stock, purchasing more shares without you having to lift a finger. This reinvestment accelerates the growth of your investment, making it a powerful tool for building wealth. Additionally, consider focusing on companies that have a history of increasing their dividends, as this can help your income keep pace with inflation over time. Chapter 3 categorizes dividend stocks into three main types: high-yield stocks, dividend growth stocks, and dividend aristocrats. High-yield stocks offer higher dividend payments, but they may come with more risk, such as potential cuts in dividends if the company faces financial difficulties. Tiberius explains that while these stocks can provide significant income, it's crucial to assess the sustainability of the dividend. Dividend growth stocks, on the other hand, may offer lower initial yields but have a strong history of increasing dividends over time. These stocks often come from companies with stable earnings and a commitment to returning more capital to shareholders each year. Dividend aristocrats are a subset of dividend growth stocks. These are companies that have increased their dividends for at least 25 consecutive years. They are considered the epitome of stability and reliability in the dividend world, often operating in essential industries like consumer staples, healthcare, and utilities. When building your dividend portfolio, consider a mix of these types of stocks. High-yield stocks can provide immediate income, while dividend growth stocks and aristocrats can offer long-term stability and growth. Diversifying across these categories can help you balance income needs with growth potential. However, be cautious with high-yield stocks. Ensure that the company's financials support the high dividend and that it's not too good to be true. Chapter 4 is all about research, an essential part of dividend investing. Tiberius emphasizes that not all dividend stocks are created equal, and it's crucial to do your homework before investing. Key metrics to evaluate include the company's payout ratio, which tells you how much of its earnings are paid out as dividends. A lower payout ratio suggests that the dividend is more sustainable, while a very high payout ratio could be a warning sign that the dividend might be cut in the future. Other important metrics include the dividend yield, which is the dividend as a percentage of the current stock price, and the dividend growth rate, which indicates how much the dividend has increased over time. Tiberius also advises looking at the company's overall financial health, including its debt levels, revenue growth, and profitability. He suggests paying attention to the company's industry, as some sectors are more prone to paying stable dividends than others. To put this into practice, start by using financial tools and websites to analyze these metrics for the companies you're interested in. Look for companies with a sustainable payout ratio, generally below 60 to 70%, and a solid track record of paying and increasing dividends. Be sure to compare the dividend yield to the industry average to ensure it's competitive but not unusually high. Also, consider the company's earnings stability and the economic conditions of the industry in which it operates. By focusing on financially healthy companies, you can reduce the risk of dividend cuts and build a more secure income stream. In Chapter 5, Tiberius walks you through the process of building a diversified dividend portfolio. Diversification is key to minimizing risk, and Tiberius recommends spreading your investments across different sectors and industries. This strategy helps protect your portfolio from sector-specific downturns and ensures a steady income stream. Tiberius also emphasizes the importance of considering the size and stability of the companies you invest in. Large-cap companies often provide more stability, while mid-cap and small-cap companies might offer higher growth potential, but with greater risk. Additionally, he suggests diversifying geographically by including international dividend-paying stocks, which can offer exposure to growing economies and reduce reliance on the performance of your home market. To build a diversified portfolio, start by identifying a mix of stocks across various industries like healthcare, technology, consumer goods, and utilities. Each sector behaves differently in various economic conditions, so diversification helps stabilize your income during market fluctuations. Additionally, consider the geographical diversity of the companies to further mitigate risk. Regularly review and rebalance your portfolio to maintain the desired level of diversification, ensuring that no single sector or company dominates your holdings. Chapter 6 emphasizes the importance of actively managing and monitoring your portfolio. Tiberius suggests regular reviews of your investments to ensure they're performing as expected. This includes tracking dividend yields, payout ratios, and staying updated on any changes in the company's financial health or the broader market. He also discusses the importance of keeping an eye on the news and earnings reports for the companies in your portfolio. Changes in management, new product launches, or shifts in industry dynamics can all impact a company's ability to maintain or grow its dividend. Tiberius recommends having a plan for when to sell a stock, such as if a company cuts its dividend or its financial health deteriorates significantly. Set a regular schedule, perhaps quarterly or semi-annually, to review your portfolio's performance. During these reviews, check whether any companies have cut their dividends, if their financial health has weakened, or if their dividend yields have dropped significantly. Consider setting alerts or using financial news apps to stay informed about any major developments affecting your stocks. This proactive approach allows you to make necessary adjustments to keep your portfolio aligned with your income and growth goals. Also, be prepared to make tough decisions, like selling a stock if it no longer meets your criteria. In Chapter 7, Tiberius discusses the tax implications of dividend investing, a crucial aspect that can significantly impact your net returns. Dividends are generally classified as either qualified or non-qualified. Qualified dividends are taxed at the lower capital gains tax rate, while non-qualified dividends are taxed as ordinary income, which could be at a higher rate. Understanding the difference and how dividends fit into your overall tax strategy is essential for maximizing your after-tax returns. Tiberius also highlights the benefits of holding dividend-paying stocks in tax-advantaged accounts like IRAs or 401(k)s. In these accounts, your dividends can grow tax-deferred or even tax-free, depending on the account type, allowing you to maximize compounding without the drag of annual taxes. To maximize your returns, consider consulting with a tax advisor to understand how dividend income will impact your overall tax situation. Holding dividend stocks in tax-advantaged accounts, like a Roth IRA, can allow your dividends to grow tax-free, making these accounts ideal for long-term compounding. Additionally, be mindful of the holding period requirements for qualified dividends to ensure you benefit from the lower tax rates. Always consider the tax implications of your investments as part of your overall strategy to keep more of your hard-earned income. In the final chapter, Chapter 8, Tiberius highlights common mistakes to avoid in dividend investing. Some of these mistakes include chasing high yields without considering the sustainability of the dividend, failing to diversify, and not reinvesting dividends. High yields can sometimes indicate a company in financial distress, which may lead to dividend cuts or even bankruptcy. Tiberius also warns against making emotional decisions, such as selling in a panic during market downturns. He emphasizes the importance of sticking to a well-thought-out investment plan and not being swayed by short-term market movements. Another mistake is neglecting to adjust your portfolio as you approach retirement or other financial goals, which could expose you to unnecessary risk. To avoid these pitfalls, focus on quality over yield. High yields can be tempting, but often come with higher risks. Instead, prioritize companies with a strong history of stable and growing dividends. Diversification is also key. Spread your investments across different sectors and regions to reduce risk. Finally, stick to your investment plan, reinvest your dividends, and avoid making impulsive decisions based on short-term market movements. A disciplined approach is essential for long-term success in dividend investing. Consider setting rules or guidelines for when to buy, hold, or sell a stock, and avoid making decisions based solely on fear or greed. And that's a wrap on our detailed summary of by Gr. Tiberius. This book is packed with valuable insights that can help you build a dividend portfolio designed to generate steady income and grow your wealth over time. From understanding the basics of dividends to creating and managing a diversified portfolio, Tiberius provides a comprehensive guide to dividend investing. If you're ready to dive deeper and start implementing these strategies, be sure to check out the full book. There's a link in the description below. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and hit the notification bell so you don't miss out on more content like this. And if you have any thoughts or questions, drop them in the comments. I'd love to hear how you're applying these insights in your own investing journey. Thanks for watching, and I'll see you in the next video with more money in your pocket.